Joining us now is Clarence Otis. He's the former CEO of Darden Restaurants. Clarence, it's great to have you back. Welcome.
Thank you. It's good to be back.
I'm biased towards the latter, which is I look at this and wonder if it's papering over some bigger challenges. They may not be structural. They might be cyclical. The company was talking about how at fine dining restaurants, consumers didn't really show up this summer and things like that. What do you think is going on here?
Well, I do think there are some larger issues that are out there with the economy. You've seen softness in the restaurant industry, and you've seen that across segments. So quick service, casual dining, fine dining. But I think that we're moving toward the end of that cyclical softness. When you look at what the Fed has been able to accomplish, it looks like they're going to be able to accomplish a soft landing. And so what that means is as inflation comes down and the pressure on spending comes down for customers, the employment market still looks healthy. And so with a healthy employment market, I would expect demand to start to strengthen. And so from that perspective, I think we're in the right place in the cycle. So I wouldn't be as concerned because ultimately employment levels, even if they're a little bit more muted than they have been over the past couple of years, are going to drive solid demand.
The only thing that puzzles me is I think about Chili's. There have been a couple of restaurant names absolutely on fire this year because their gap, their kind of cost gap to fast food has caught up. In other words, when McDonald's is charging $10 for chicken nuggets, suddenly sitting down and getting a 3-course meal for $10 at Chili's or what have you looks a lot better. So why do you think Darden has been caught slightly off foot? I looked at the comps. The comps were not that good last quarter, down 6% in some units, down 3% in others. Are they somehow off trend? Do they need to cut price more or do something to be more relevant to the consumer right now?
I don't think so. I mean, I think Darden's pretty well positioned. The numbers I saw said that for this past quarterly period for Darden in casual dining, same restaurant sales were down roughly 4%. So Olive Garden was down a little bit less than that, nearly 3%. But overall, when you look at Darden, down 1%. And so Darden has the advantage with the kind of portfolio it has of really having some brands offset softness at others. You saw that this quarter when you looked at Longhorn, which was up a couple of points. And so I think they're pretty well positioned from that perspective. I do think in response to the pressure that consumers have been facing, you have seen more discounting. The folks I think that will be most successful will be more artful with that discounting. So instead of putting the entire menu on sale, really offering specials that do have limited timelines to them. And so that's happening. And I think Darden has done a good job, always seems to be able to do a good job with those kinds of dynamics. And they're extraordinarily well positioned because of the portfolio nature of the business.
Quick comment that makes me more sympathetic to Evercore, which did the upgrade. And they say, and I'm curious if this is true, that the company is now going on the offense and advertising protein offerings on the menu. During the course of my lifespan, I've gone from being a devotee of the breadsticks and spaghetti to basically not eating any carbs at all. And I'm trying to get to however many protein grams is my body weight, and it is so hard. And if this company just delivered, sauteed chicken, and that alone, I think it could have our entire household business. So is that potentially a differentiator or a way that we should be looking for more offerings that might kind of drive sales, drive Uber traffic, and so forth?
Well, each brand has their own identity and they have their own consumer proposition. And so Olive Garden has a very strong proposition. It's actually the strongest brand in casual dining. And it has protein offers, but it's not protein heavy. It's not the same as, say, again, a Longhorn, which definitely is much more protein forward. So I don't think they're going to veer very much away from the brand envelope because that's what consumers expect, but that's why the diversification makes a lot of sense. I do think there are other steps that they can take, and I see the potential partnership or the announced partnership with Uber around delivery as a definite step in the right direction.